markets is this shift towards interest rate cuts. The Bank of Canada is widely expected to cut interest rates for a third consecutive meeting next week. We're obviously hearing a lot about rate cuts in the U.S. as well. And there have been stock market implications. Even looking at the Canadian stock market over the last 3 months, one of the best performing subgroups are real estate related names. To talk a little bit more about investing in Canadian real estate, we are joined by John Ewing, Chief Investment Officer at Ewing Morris Investment Partners. Nice to see you.
Nice to see you too, John.
So a lot of people have been waiting to see this real estate story start to take shape, and as the numbers tell us, it's definitely been happening. What's been your observation?
Yeah, we think we're at the beginning of a big rotation back into REITs, where it's been an underperforming sector last year, first part of this year, but as rates come down, I think you're going to see a lot of people cash in their GICs, term deposits, and rotate back into REITs, where you can still get a 5, 6, sometimes 7% yield with really good tax characteristics.
The mechanics that you just talked about are interesting too. Like there was a big strategy report on Bay Street over the last week or so, suggesting at some point, assuming rates do come down, there could be a flood of money that comes to the stock market, various sectors, maybe real estate, because of that phenomenon.
No, I think that's right. And because, it's most things in markets anticipate, but this is the type of situation where, if the 5% GIC you bought 3 years ago matures in October, you're not rotating into REITs until that comes. And if mine matures in November, I'm not moving until then. And so I think it's a little slower moving, but just as likely.
Okay. Now, at the end of the day, when we talk about investing in real estate, there's lots of different flavors. So how are you thinking about where you want to be positioned in real estate?
Yeah, I mean, we really like commercial real estate outside of office, and retail real estate, I think, is our favorite sector, where we just think the fundamentals are great.
Okay, let's go through some examples. For example, First Capital is a stock you like. That would be tied to retail REIT?
That's right.
Yeah.
It's a big grocery anchored retail REIT. We really like it for 3 reasons. You've got, first, fundamentals are great. Big population growth continues in Canada, and nobody's building new grocery stores, so rents are going up. First Capital, we think, has the best assets in the space. And, don't ask us, you can ask the tenants, where, 3 of their biggest competitors are also their 3 biggest tenants. Like Loblaw hates renting from First Capital, but they don't have a choice because First Capital's got the best dirt. And the third one is around valuation, where, we think First Capital is a prime takeover target. The stock has moved up, but still trades at a 20% discount to its net asset value. You've got, we think that net asset value is firm. Every quarter they're out selling properties at 10, 20, sometimes 30% premiums to net asset value. And we know that there's institutional buyers out there who would love to own some, and in a few cases all of this portfolio. And we recognize that it's hard for CEO to put himself out of a job sometimes, but we just hope that the board has all the information and to understand and appreciate the strategic interest that we think is out there right now for First Capital.
Is that M&A theme another consideration? Like, you think that if there's momentum for the sector broadly, that possible and who are those buyers? Are they other REITs? Are they private equity players? Whatever.
It's both. I mean, there's when you see consolidation amongst retail REITs that you've seen in the U.S. Then there's often big synergies. You've got private equity, Blackstone.
Yeah, they came up here in a big way.
Came up here with Tricon.
Yeah.
They've shown some interest in retail assets, and so it could be either one.
Okay. You also look at where these businesses are based as a consideration as well. You've actually got an Alberta theme that you've been tracking through the REIT sector. Can you tell us a little bit more about it?
Yeah, I think if Alberta was its own country, and there's a lot of Albertans that wish that it was, it would be the fastest growing country in the world right now, population-wise. And supply is just not keeping up. And real estate's all about supply and demand. And so I think that's great, again, outside of office. And so the most obvious way to participate in that in Alberta would be Boardwalk. That's got great apartment assets. If you can own sort of smaller cap names, we think Melcor Developments, which is a 100-year-old family controlled business that's one of the biggest landowners in in Alberta is another interesting way to have pure exposure to Alberta.
Okay, Boardwalk, BEI, and Melcor MRD. Do you guys at Ewing own
We own
those
both
names?
of those.
You
Yeah.
own both of those. Because Canada has a pretty well-known REIT market, might be less known. Look, our audience is very smart. I'm sure they know this already. But this sometimes becomes a place where players with exposure in other markets like the U.S. will list. Is that a theme you're watching as well? Cross-border REIT plays?
Yeah, no, cross-border REITs, they pop up from time to time, and they never seem to last very long. And you just often see this mispricing between the private market for real estate in the U.S. and cross-border TSX-listed vehicles. And Tricon that got bought earlier this year was a good example of that, with almost all its assets in the U.S. And there's a few others out there right now. We like Flagship Communities, which owns mobile home communities in kind of the Midwest, but. There's BSR that owns apartment buildings in the Sun Belt. There's American Hotel Properties. There's some other cross-border REITs too. Okay,
Flagship is MHC. Hey, real quick question. You mentioned office as a cautionary point a couple of times. What's your biggest concern there?
You got vacancies depending on the city, but call it 20% in office across Canada, and you can't raise rents when there's that much empty space. And lenders hate office right now. And so if you can't raise rents and you can't borrow money, real estate doesn't work very well.
Okay.